Yes, good morning. Although it's slightly past noon, but I'm still on my own schedule here. It's a great pleasure to be here. It's my third time visiting Malta, but the first time in a professional capacity. So it's really nice to be here at this wonderful conference. It's a really great portfolio of talks and discussions you've put together. I'm glad to be part of that. I'm actually going to switch gears a little bit in terms of the topic. We've talked a lot about issues related to financial products, regulation of finance per se, and the finance sector overall. I'm going to be a little bit more general in terms of discussing corporate governance issues, which I do think are very relevant for you also. I think, for example, this afternoon there's a session on the Maltese Stock Exchange where this is going to be, hopefully, to some extent directly relevant. I need to make one further disclosure at the beginning. There's one affiliation, a new one. I'm a board member now at the institute called SWIPRA, which is Swiss Proxy Advisor. It's a new proxy advisory company. So I'm going to talk about three different issues. There's many more in corporate governance, but I want to highlight three in this limited time I have. One is I'm going to briefly touch on executive compensation. That's all the rage at the moment, of course. So there I'm going to talk about new regulation coming our way, coming your way, in terms of the EU regulation. Second, I'm going to discuss the issue of shareholder power. Is it really a good idea that shareholders have more power, for example, when setting pay, but also when engaging in other aspects of governing firms? And third, I'm going to briefly touch on disclosure issues. Oftentimes, companies, in my experience, have a little bit of a sort of relaxed stance, let's put it that way, about disclosure in the sense that they think, okay, this is something we have to do for the purposes of compliance. I'm going to try and argue and convince you that actually there's a lot to be said for actively pursuing voluntary disclosure quality. It helps with many aspects. So I'm going to just be able to raise awareness for a few issues. I don't have any ready-made concepts for you, because a fourth item, which isn't on here, really is there is no such thing as best practice. Every company is unique. Every company has its own technology, its own business model. And the key issue is to fit governance, be it compensation matters, but also other elements of governance, to that company's requirements. So anything that's a blueprint, I suggest you are very aware of that that's not really going to work so well. Okay, so maybe let me jump right in. I'm sure many of you know what happened last week. The European Parliament finally voted with very high majority in favor of a package called CRD4, Capital Requirements Directive 4. There's many things in that, but in that requirement, in that directive, Article 90 now has a one-sentence statement about the fact that the maximum ratio of variable pay to fixed pay is supposed to be only up to 100% in credit institutions and other financial institutions. Now, so this means, suppose base salary is 100,000, then you can pay a bonus of up to 100,000, not more, going forward in these financial institutions. This may not be a binding constraint for some. It is a binding constraint for others. It sounds like, oh, well, this is only the financial services industry. My guess is it will also feed back into other areas of corporate governance. So I suggest this is one of these aspects that everybody really should be aware of. Don't wait for details here, is my advice. Last time around, CRD3, the predecessor of the European Banking Authority, EBA, the predecessor issued its final guidelines 21 days before CRD3 went into effect. I don't suggest you wait until that happens with the precise guidelines for CRD4 as well. So this goes for the executive compensation issue, but also for everything else. So what are aspects that I think are relevant for you to consider? Depending on where you are, depending on whether currently you're in a setting where you are above this ratio of variable pay to fixed pay or below, it has different implications. Some of you may benefit from the fact that other companies are not able to pay this ratio of variable to fixed pay anymore. So some are arguing, for example, that while the UK is going to have real troubles retaining staff, other financial centers may benefit from that. On the other hand, if you are in the situation where you might potentially be running into this binding constraint for variable pay, you're maybe well off thinking about alternative ways of conveying compensation. So for example, I'm just highlighting some thoughts here, bail-in bonds or contingent convertibles as a matter of compensating individuals is going to become more relevant. What do I mean by that? Basically, you're getting paid with a bond which turns into equity when things run poorly. Okay? So that is supposed to be giving individuals an incentive to be a little bit more circumspect when it comes to risk-taking. That's not really been shown, but that's one way maybe to get around this. There's other ways also. The point is, it's becoming ever more important, and that's really what I want to focus on, to think about what's a good compensation system. Because companies need to convince regulators that what they're doing is in the spirit of this new regulation, and they also need to convince shareholders and other stakeholders that what they're doing is really making sense. So let me spend a couple of minutes talking about a myth and partially dispelling, hopefully, that myth as relates to what a good compensation system does. One myth, which I often encounter in my work advising fairly large corporations in Switzerland, but also smaller ones, is that a good compensation system is one where you're linking pay to measurable and controllable performance indicators. It's a little bit abstract. What does that mean? Some people perceive a problem in corporate governance when managers are being paid for things that they cannot influence. Right? It's easy to say, well, can that really make sense that the manager benefits from the stock price rising in general? Well, he didn't have anything to do with that. Why should a general banker in a department inside the bank, private banker or investment banker, have an advantage from generally rising stock prices? And on the other hand, why should they be punished for generally falling stock prices, for example? Well, to understand this issue, I want to touch on three key issues in incentive design. Every incentive system needs to make sure that what you're rewarding people for is aligned with the overall target of what you're trying to achieve in that corporation, aligned with value generation overall. That may be increasing the stock price, but more generally increasing firm value, say. Another element, indeed, is controllability. I mean, if all incentives are completely outside the realm of what individuals in the organization can influence, it's unlikely that this will have any effect on their behavior. I think that's also clear. The third element is interdependencies, or I'm just going to write down teamwork. In today's economy, we are working together producing output. We're not individuals producing pairs of shoes, each one of us individually. We're working as teams. These three things need to fit together, and I can mention only one area of conflict here, and that's here. If you have a system in place which rewards individuals more for what they can control, you get what you pay for. Okay? I'll tell you a story. I love storytelling. There was a company, it's a real story, an industrial company back in the day, but it happens all the time now. The managing directors thought, okay, our secretaries are not really productive enough. They're not producing enough output, they're not writing enough letters, we're not getting enough work done. So they thought of putting in an incentive system. So they thought long and hard, okay, what is really connected to output? What can we measure? How can we have a measurable incentive system? And they came up with the brilliant idea as follows. They said, okay, we are observing how much typewriter ink they're using, right? These were the days of the typewriters. We are seeing this is directly correlated with their output, right? How much typewriter ink you use, that's indicative of how many letters you're producing. So they put in a bonus system for usage of typewriter ink. What happened, it's a real story, but not unlike many of the things we see in many companies today, what happened was the secretary started typing one single letter during the lunch break, using up the ink of the typewriter, but that has nothing to do with value generation for the company. This is an extreme case, but if you think about it, rewarding individuals for selling a number of loans, for example, is basically the same idea. Rewarding individuals for anything they can directly control is bound to create some manipulation at the end of the day. So there needs to be an element in the incentive system which is not controllable, which you can maybe react to. Right? Even if the stock market changes around in wild fashion and you can't control it, you can think about, well, how are we going to react to that? Incentive systems should award and reward that kind of flexible thinking. This is just one element that I want to highlight here. Formulas don't always deliver consistent or sensible results. This is true both in the direct incentive compensation area. It's also true in the risk adjustment area. There's now all the rage is, oh, we want to adjust compensation for risk ex ante, and we try to do this with formulas. I'd be very, very careful for this, because formulas can always be manipulated. At the end of the day, my learnings from academic research, but also from what companies are actually doing and what I see them doing, is you need to keep some discretionary element in compensation. And for that, you need to have a strong board. A strong board is the ultimate and only source of good governance in an organization. And what is a strong board? Well, a strong board is one, first of all, that's competent. You know, competence of boards has become a key issue, really. Now, I suggest, although I shouldn't maybe be saying this, but I'm going out on a limb here, that Malta, as a relatively small economy, is in a potentially precarious situation in that respect. You have very competent people inside, but you need more as you grow. So you need to get people here. You need to educate people more. It was mentioned earlier on this morning that education is really the key aspect. Getting competent board members who are strong enough to withstand management, executive management, is a really central element of good corporate governance. It beats everything that can be done with regulation. Okay. The second element I want to mention is shareholder power. There's a myth going around, a second myth, which is shareholder power is always good. It's always good that shareholders get more power, and that's, at first sight, that sounds right. Shareholders are, in some way, the ultimate owner of a company. Not really, because the company is an entity in itself, so it owns itself, but still, they're the residual claimants, so maybe they get special rights. On the EU level, there's big regulation that way also. For example, the European Commission has said that it will issue a directive for say on pay in member countries in 2013, meaning that if you're the shareholders, I'm management, you are going to be voting on my compensation in many EU countries in the near-term future. I can report on a natural experiment we just did in Switzerland. So we love this as academics. We don't just do things in the laboratory, but we really try things out. The Swiss public has just voted on the so-called Abzocker initiative, which translates into anti-rip-off initiative. Switzerland, one of the very capitalist countries in the world, has just voted in the most stringent executive pay regulation in the world. It is now in part of the constitution of Switzerland, and basically, although the correct and specific law still has to be designed, what it means is shareholders will vote in a binding fashion every year on compensation of CEOs and other management. Now, I can only mention one thing here. We did an academic study, and if you're interested, obviously the slides are at your disposal, so you can look at this. We did a study, an event study, on how stock prices reacted to this initiative. What we found, surprisingly, was shareholders don't like this initiative at all. On average, stock prices dropped by 1.5 percentage points when this initiative was announced. And now you're thinking, well, are these guys crazy, these academics? They're doing something wrong here. How can it be that shareholders don't like getting more power. Well, we asked ourselves the same question, and then we tried to understand, well, what are the differences between firms and their reactions? It turns out that there is actually method in the madness. For example, companies that had performed very well in the past suffered a lot through this new regulation. That makes sense. If you as the shareholders think I'm doing a reasonably good job as management, you don't want to interfere at the General Assembly. You want to let the board and management do what they've been doing because they've been creating value for you. On the other hand, companies that had performed relatively poorly, there the stock price reaction was only barely negative, it was not significant. So there actually, there's an argument to be had that in poorly governed firms, actually this regulation helps, but in well-governed firms, it destroys value. What is the implication for you? Why am I telling you this? Just jumping to one point here that is hopefully directly, or maybe directly relevant for you. As the Malta Stock Exchange is looking to develop value further for Malta, and as banks are maybe helping firms to go public or to do a better job growing, you need to take these developing shareholder rights into account, both within Malta and also cross-border, because shareholders are international. For example, in Switzerland, most companies are actually held by non-Swiss investors. So being aware of those international developments is absolutely critical. The final point, just the final 3 minutes of my talk, I'm going to discuss communication with shareholders. As shareholders have more power, companies need to do a better job communicating with them. That's almost a trivial statement, but my experience, at least working with board members in Switzerland, is that companies are often quite reluctant in talking too much about what they're doing, about disclosing how they are managing their company. So what I formulated here is the third myth is that disclosure, that's just something you have to do, but really it's a waste of time and value for everybody. I want to report on substantial academic research and practical anecdotal evidence, but by and large empirical research that tells us that actually voluntary disclosure quality, so reporting where are you creating value in a company, how are you creating it, what are trends you're seeing, those things actually help a great deal. Firms that do a better job communicating with their stakeholders have lower cost of equity capital and lower cost of debt capital. That's not just something that Alex Wagner is putting out there. This is an empirical fact in the data. Why is that the case? Well, the logic is pretty simple. If you're the shareholders, I'm management, and you trust me more because I'm more transparent about what I'm doing with your money, you're less likely to demand a high risk premium from me. So you're willing to give me a better deal on equity and on debt. And overall, that creates value because, as we all know, in valuation, companies' valuation goes up when cost of capital is lower. This is the cost of capital side. Interestingly, there's also an internal side. If I, as the CEO, need to explain or commit myself to explaining to you clearly in the annual report, for example, this is how we, this is the kind of return of capital we had, this is the cost of capital we had, these are the areas where we have done well, these are the areas where we have difficulty, this is what we think is going to happen, then this is going to lead to better internal decision making because I can only explain something to you which I've really understood. I cannot disclose anything if I haven't understood it. But if I force myself to explaining it to you in terms that everybody can really understand, then I can make better decisions, and that's what we see in the data. So ask yourself, do you, in your personal areas where you work, or also the board and the management who you work with, do you really understand the value drivers of your institutions? That's both for financial institutions and for general industrial companies, for example. Do you have an appropriate strategy and philosophy regarding these things? Can you explain how you're really linking costs of funds and return made with the use of funds. This is not something that many companies can do, but those that can actually do quite well. Think of value reporting as an element in a chain of value creation. This is not, you can't outsource disclosure to somebody in the organization and be done with it. Value reporting needs to be something that the board is aware of, works on with the overall organization. It's an element of the value creation chain. So the bottom line here is that disclosure is an opportunity, not something painful. In conclusion, I've touched on 3 elements, 3 myths, and hopefully 3 implications. I've talked about the new regulation coming our way as regards executive compensation. The key element here is it's becoming ever more important to think about what is a good compensation system, a system that fits your company. Second, shareholder power is on the rise. Say on pay is just one element, there's many others, but it's not always a good thing. And this goes to the regulators, but to the companies, that's a reality. You need to communicate well with shareholders. That's the third point. Value reporting actually creates value. Thanks so much.